Hello, hello. Welcome to tonight's webinar. Kind of impromptu, but I feel like given the move here in ARM after hours, that it's probably something that we should talk about. This is impromptu. I have nothing planned. So we're going to roll through this. It'll probably take 20 to 30 minutes, but you're going to learn something very valuable. And what you're going to learn that's so valuable is something called our IPO range breakout play, also known as our Big Blue Skies setup. If you've been following any of our content on Twitter for an extended period of time, YouTube for an extended period of time, we have played these Big Blue Sky setups before. These are not new. We did not invent this setup. Although just like every other setup we run inside of the Trading Initiative, we have changed it enough to fit our time frame and our style that it should be called something else. In this case, we call it the Big Blue Sky Breakout. So what I'm going to do is I'm going to show you how to find these. Right? I'm going to show you how to scan for them. I'm going to show you how to trade them. I'm going to show you a couple of examples if I can remember them off of the top of my head, but we're going to be focused on the ARM trade in particular because that's the one that just went off in ER after hours here about an hour and a half ago. So we'll start in about 30 seconds. Buckle in. We're going to get through this fast, but like I said, it's going to be informative rather. We're going to go ahead and start our market research portal. Little sales pitch here, but honestly, it's because I want to show you the actual trade idea we put up in November. This is what you get access to if you do sign up for us on a quarterly basis. You get access to our market research portal filled with multiple newsletters per day. In this case, we deep dive Chinese stocks. Video just came out on YouTube actually about that. We're not buying them. But trade ideas, another portion here. So I'm going to show you exactly what we were looking at in November when we actually wanted to own ARM to begin with. Because it's important to understand what the setup looked like when it very first hit our radar. So you can see here the chart. This is very basic. So this is where I want to start. It's what is the actual setup? Few key things here. Recent IPO. So when we scan for these, we're going to set up the scanner in a second. I'm going to show you how to do that. We're looking for 2 to 3 years ago, so recently IPO'd. The reason why we like 2 to 3 years ago is because we just came out of a bear market. Most IPOs gave us some sort of markdown or drawdown. If you're into Stan Weinstein, a stage 4 downtrend before bottoming out. So we wanted to get rid of all of that. We're trying to find names that are building bases, etc. If you've seen any of our content, we love to buy base breakouts. If you're a technical trader, you should love to buy base breakouts. This is like TA 101. And in this instance, very obviously, we have a base. IPO'd back in September. Now, if you remember what the market was like back in September of 2023, we were about second, about 2/3, I guess, the way through the corrective phase. Go ahead and pull it up on TradingView actually so you can see exactly what I'm talking about. We're 2 to 3, about 2/3 the way through the corrective phase in the market, somewhere in here, right? So it IPO'd in the middle of a market drawdown and nobody wanted to buy this, which is important for the setup itself. Nobody wanted to go out and buy this. Nobody wanted to buy an IPO name as the market was correcting because, well, there was added risk to that name. So when we found it, instead of it drawing down, which I'm going to show you the actual video. I don't know if it's going to come through well on YouTube. If it is, I'm going to play the entirety of the video. It's like 3 minutes long, but it really gets you inside of our brain of what we saw at the time, which is probably the most valuable part of this entire video, is how did we actually spot the trade and set it up? We noticed right off of the bat that as the market corrected an additional 4 to 5% after this was already IPO'd, this went sideways instead. And inside of the Trading Initiative, when the indexes are going down and the asset that we're comparing it to is going any direction except down, it could be going up or sideways or even down, but less down. That's a really good way to put it. We call that relative strength, right? This was showing relative strength. The entire market was coming down and ARM was not. ARM was going sideways. So we knew that when or if the market decided to find a floor and bounce, we wanted to be long the names that were showing relative strength, and ARM was in that category of stocks we wanted to own. We've been trading this IPO range breakout high for 4 years now. I will tell you right now before we dive into it that it is probably the most powerful single setup that we have. If you go back and study history's biggest moves, depending on the market conditions, these can be the biggest plays you'll ever enter. If you go back to 1995, from that 95 to late 99, absolute heyday run up into the dot-com bubble, these IPO range breakout highs put you in some of the best performing names over a 3 to 5 year scale. I'm telling you right now that some of these IPO names that you eventually break out or that you buy on the breakout are going to end up as some of the market's best companies 10 to 20 years from now. And you're going to go, fuck, I remember I bought that at the IPO price. Happens to all of us. ARM, I have no idea if that's actually going to happen too. It's just a really great trade here. So let's set the stage here. Recent IPO break, up and over. You see a horizontal resistance area. It's like TA 101. We give sector and industry info. Why is this important? Tech was the leading sector of 2023. Semiconductors was the leading industry group of 2023. We wanted semi exposure, and you're going to hear that in a second in the video that we posted back in November. I think it was the week of Thanksgiving. We knew we wanted tech and semi exposure if the market had found a floor. That was it. That was the leading sector and industry group. So why the hell would you look anywhere else first for stocks? That's where you need to be. Now, at the time, I'll tell you right now that recent IPOs are generally smaller mid caps. This one in particular IPO'd at a huge valuation. So it was a large cap. This is a spinoff of NVIDIA. So it's a little different than most of the IPO-based breakouts that we trade. The reason why this matters, though, the allure of trading these IPO-based breakouts is that they're generally higher ADR, small and mid caps. Anywhere between 5 to 10% ADR, actually. So from a shares perspective, you can get very volatile moves very quickly. And if you can time them right in the direction that you're looking, you can make a very sizable gain on the breakout in a very short amount of time. That's the allure of trading these. In this case, this was a large cap at $56 billion market cap. Let's go ahead and look at what the market cap is right now. I think it'll update tomorrow after what's going on, but now it's a 74 billion, so it's added about 25 billion. That's cool. Some volatility instructions of 4.86% ADR. That gives us a clear understanding that this is a volatile large cap. There's not very many large caps that trade at this type of volatility level. Now, part of that is because it's a recent IPO. The market doesn't really know what to value it at. But to us, that's edge. That is edge. That's something we want to be a part of. Risk levels, we wanted to own it above 56.5 and a break below 53.5. We'd second guess the opportunity. We had price targets at 63 and 70. That was the original setup. Now, remember, this was posted in November. So the original play, we didn't really know what was going to happen after the new year. We had reasonable expectations that we were going to enter a bull market in 2024, a continuation, a second year of the cyclical bull. 2024 presidential election cycle. I'm sure you guys have seen a lot of that content that we've put out. It's not rocket science. We were bullish coming into 2024, but we didn't know if we wanted to own this particular stock past this IPO-based breakout yet. It had yet to prove itself. And so we generally go out pretty far. We generally go out 6 months at a time when we really like a stock. In this case, we only went out about 3 months. So we got the January 19th as our first position here, 62.5 for no more than $120, $1.20 per contract. So this is how we always label things inside of TTI. We always have some sort of options play and shares play if applicable. We give you the exact options play that we agreed on as a community. It's not just me barking orders. It's the entire community. And we always put, you can buy up to whatever price point it makes sense. You go over this, you're starting to get in some overvalued territory. So I have no idea if this video is going to come through on the stream. Please, I think there's a 15-second lag time on the stream. So if it doesn't come through, please let me know and I'll stop it. But I really think there's a lot of value for you guys to listen to the exact thought process on the morning that we opened this. So let's try to play this. And if it doesn't work, let me know and I'll stop it. What's going on, guys? Welcome back to yet another week of the crazy market. This week is Thanksgiving week. It's going to be a short week. So we're going to go ahead and start with ARM, a trade idea here on a large cap semiconductor name. For those of you that know anything about ARM, it's a spinoff of NVIDIA. It IPO'd very recently back in September. And we have been stuck in somewhat of a sideways consolidation zone as the market has come back slightly. ARM went sideways. Relative strength there. at the very least, right? Not necessarily a huge winner yet, but relative strength with past RSI is above the 50. We think that this is a decent opportunity to catch a potential sympathy run with NVIDIA, right? So NVIDIA is going to be an expensive play. $800 to $1,000 a contract for things that we're looking at. ARM is going to give us a potential vector in towards the NVIDIA earnings play while paying about 1/8 of the price. And so that's why this particular setup looks attractive. From a technical standpoint, this is a potential big blue skies breakout, but it does not really have the length of the base that we normally like. So take this with, this could be a little bit riskier, right? A little bit riskier of a trade from a shares perspective and an options play, because even for shares, on a gap down on NVIDIA, we could see this massive 4.86 ADR with a 2.62 ATR. This could gap down easily 8 to 10%. So please keep this in mind when you're allocating your position sizing. This is going to be a little bit riskier of a play. Understand that it's a recent IPO. Market is still trying to figure out supply and demand and price equilibrium and everything else, right? So the way we like to play this is above 56.5. We're currently trading 55.58 pre-market. We want to own this thing with a price target of around 62.5 to 63. It's that first fib. Then $70, right? Near that all-time high. And then just follow the fib extensions up, 72.5, et cetera. Continue to chip profit off of the actual play if it does get up there. We want to get out of this thing. Normally we play the 786 fib, right? Down here, this 54.36. But let me show you something really quick. If we take this 56.5 entry, or here, let's just take right now. If we take the 55.58 entry and we shift click down, we can look at the ADR, which is 2.34, right? Excuse me, ADR is 4.86. This is only a 2.34 move. What is that essentially telling us? If we open up the play today and we stop out at that 786 fib, we're not even giving this thing a full day's worth of normal volatility to work. And that's not what we want to do inside of a swing trading program. We want to give this thing a couple days of respite. Understand that generally these things are going to consolidate underneath the overhead resistance area before breaking out, even if we shift click down from the original risk level that's still below 1 ADR. So that's why we're pulling the stop down just a little bit more than what we normally do, which also adds into a little bit slightly elevated risk on this play. But the cool thing is this gives us an opportunity to capture any sort of semiconductor exposure to the upside if NVIDIA beats and shoots up and over 500, which I think is a reasonable expectation. I'm not sitting here saying it has to happen, but that's kind of a reasonable expectation, right? One thing I will tell you, we've been trading these specific setup for a while, right? The big blue sky setup, recent IPOs. A lot of these names run not only up into all-time highs, but they continue to run for a while. So if you are a shares trader and you grab a piece of this ARM play and it does work, right? We break out and we hit new highs or whatever. Maybe as you're coming out of the position, taking a little bit off on the way up, maybe hold just a small core amount of shares there. Who knows what ARM's going to be worth in 5 years? That is not financial advice, but we've been in a few of these. All right, let's stop it there. You can get the general idea, right? We were bullish on ARM. That was the setup. It ended up playing out. So let's actually go towards what happened with ARM. As you can see, a little prophetic messaging there saying, who knows what ARM's going to be worth in 5 years? I should have said in 3 months, basically doubled in value. So it was a fantastic opportunity for the guys that were able to hold some shares from the beginning at 56.5. But I don't want to sit here and paint this rose-tinted picture here that everything was great. This was not the most easy trade in certain aspects, but we did manage it very well inside of TTI. And a lot of it came from the fact that we were able to capture it from essentially the best breakout spot that we possibly could at 56.5. So I'm going to show you how we actually managed this trade, intra-trade, and how we were able to position ourselves again to take advantage of ER, because obviously we did not have this much exposure on the books when we originally opened it. We were gunning for those January contracts. And what you saw here was NVIDIA did actually beat, but it took a while for it to get up and over 500. We expected it to get up and over 500. We're in the business of riding trends. We're not in the business of trying to call tops or bottoms and predicting. I don't give a shit about CoreWeave. I don't care about anybody's conspiracy theory. I think most people are really stupid in the market, to be honest with you. Whether that's a fault of mine, I'll take that with me to the grave. But it seems to do me pretty well not giving a shit about other people's opinions on our specific stock setups. The reason why I bring that up is NVIDIA is up and over 500. As a matter of fact, it's up and over 600. So if you listen to what people tell you all the time, particularly in the stock market, when they really don't have any edge other than I think, everybody has a fucking thought. Most people are wrong. That's why you don't have very many people trading that pull money out of the market consistently. So if you have a system, stick to it. ARM in particular, over the course of 3 or 4 sessions, did shoot up and hit our first price target. So we were able to turn this trade free. And this is what's kind of cool about, having a community that we're in. We have conversations every single day about positions. Holding through this chop was not easy. It looks relatively easy in hindsight. It's chop, right? But the problem is when you're trading these options, particularly when you're trading kind of close options, and for us, buying in November a January contract is very close. That's not something we normally do. We normally go like 120, sometimes 180 days out. The January contracts didn't give us a lot of time for consolidation. So as this consolidated sideways, we had to make a decision. What do we want to do? Well, we were able to turn it free, which gives us a little bit more leeway. We didn't have to necessarily pull the entire position off of the books because we had some wiggle room. It was completely free. We were playing with house money after day 4. That's kind of the perfect scenario to be long a stock that's breaking out. So as we consolidated here, we saw after about 3 or 4 sessions that we were starting to form some sort of support at $61. It doesn't take rocket science to see the candles are bouncing off of a fucking round number at 61 or 60. And so we, asked each other, like, listen, should we be sizing in on here? Should we be looking to buy the dip on this, use some of the profits that we were already pulled out of the name and reallocate them in towards some further strikes? We got the confirmation that we got the breakout. I mean, if this thing continues, we could be adding in some relatively cheap contracts because, listen, if this thing consolidates sideways, all of the calls are going to be depreciating in premium. We're getting a discount the longer this thing consolidates on the same trade idea, which is bullish. And so we did. What we did is we bought down here off of the support bounce, which is not necessarily rocket science. Once again, we just saw 3 or 4 days in a row that the market didn't want to let this thing drop anymore. And so we took advantage of it. We bought into some of that demand. Now, let me ask you something. If you buy this 61 area or 60 area, whatever, and we break below the range, would you hold? Well, if you're a technical trader, it'd be very difficult to rationalize holding a breakdown of a range when you expect a resolution to the upside. So it's important if you're starting to employ these types of tactics that you stay very straightforward with the way that you're attacking these. A set of hard rules keeps you out of losing trades that, are small losses on the books that can turn into some huge losses if you just stick your head in the sand and don't deal with it. So we said if we're buying the 61 area bounce, if we break below 61 or 60, we got to close it. Like we have to. We can't mess around with this. Luckily for us, it did. Right? It continued to go up. We shot up. We got another free trade on the second PT near 72. And then we had the same question. What are we going to do here? Is it time to really go out there and look? We still had positions on the books in December. As a matter of fact, I think we have some screenshots in Discord. I'm not going to get to it. It's fine. You guys believe me. I've been posting about ARM for months now. We still had positions on the books. It was free. Once again, it's the best position that you can be in. If you can turn these things free by selling half at 100%, I scream about it all the time. Sell half of your options plays at 100%. What does that do? Removes all principal risk from the trade. All you're trading with at that point is unrealized profits or house money. And I'm not necessarily saying that you should just YOLO all of that, but what I am saying is when you know there's no risk against your account, it's a lot easier to take a step back and breathe and let the market kind of do what it wants to do. There's no gun to the back of your head saying you need to close it right now because if you lose, you're going to lose half of your account. There's none of that. So really practice this. This is our first take profit spot in TTI. We don't ever touch a trade to the long side until it hits 100%. Most people look at 100% and they think, I just hit a grand slam. We look at 100% and say, we just hit a base hit. It's just two different ways of trading. So 100%, we were able to take half off. This is a free trade, and then we hit this consolidation zone. So once again, we had the conversation. What are we thinking about ARM? Well, we still love semiconductors. It's February of 2024, and we still love semiconductors. We expect semiconductors to pull back for sure, but we expect them to be a leading industry group. So we're constantly hunting for discounts on semiconductor names. So what did we do? It's the exact same idea as here. We found a range. We started buying the range. In this case, we went out really far, the July contract. So what you're going to see over the next few sessions, whether you're following us on Twitter at How to Swing Trade, or I'll probably upload a more in-depth, 25-minute deep dive on the ARM trade itself, is you're going to see us tomorrow. I'm telling you right now what's going to happen. We're going to close half of our trade because it's going to be up well over 100% now. It's going to be up, I think it was up like 70 or 80% for most of us going into ER. This is going to be a 300 to 500% winner, depending on the actual strike and where we open up. This went all the way up to like 107 earlier, so I have no idea where we're going to open up tomorrow, but assuming we're somewhere north of 90, it's going to be a massive win for us off the open. We're going to close half. I mean, just it's systematic every single time. We just had this conversation. Let me actually show you this in Discord. It's always funny because when you get into these Grand Slam situations, the first thing you think about is, I don't want to close this thing. This thing's incredible. But there's always the other side. What happens if it doesn't play out that way? Managing risk is always number one. Reward comes second. So we have Pat here. He says, I got a bunch of July 19th for ARM. When a beat like this happens, how long do you hold on to those for the coming months, or do you sell quicker? I have 2 contracts, so I'd like to take one free and let the other one ride. And the answer for me is always going to be turn one free tomorrow, let the other one go. Risk first, reward second. Take that with you to the fucking grave, guys. Risk first, reward second. The rewards will follow along with good risk management. So we're going to close half tomorrow, somewhere up 300 to 500%, depending on where we open. And this is great because not only is it going to turn the trade free, but if we're within anything over 100% and we're closing half, we're locking you profit as well. So we're going to get out of this trade no matter what with a big profit. We can let the other half of the trade theoretically go to 0%, which we're not going to, but it could, and we're still going to make money on this trade. That's how incredibly important it is for you to manage your risk, because you can get yourself into these situations where if you've traded it well all the way through up to ER, you have this incredible profit cushion to be able to let the contracts go through ER without a lot of risk against you. All right, so that's a little risk management tool there that you can utilize. But this is a great IPO-based breakout high that you can replicate the process. And what I want to show you how to do actually is how to scan for these, because these are incredibly powerful. It's not just ARM that looks great. Let's actually scan through this stuff, and I'm going to show you. We can potentially chart one or two of them before we call it a session. I don't want this to go much longer than 30 minutes because it's impromptu, and I'm tired. It's already 9:30 p.m. where I'm at in Brazil. So let's go to FinViz, and let's build a quick scanner here. So the number one thing about these IPO-based breakouts is obviously that they're IPOing. I mean, that's like, right, you understand? Like, that's the important part. The market is still trying to figure out the pricing dynamics on the specific setup. That's what gives us the edge to trade these things. So the first thing we got to do is define that. Let's they just changed everything around because they added some new categories here. So where is the IPO? Where is the IPO? Some of you guys are probably staring at it and screaming at me. Let's just go IPO date. So let's go within like the last, can we say 2 years? I know we can do 3 years as well, but remember the goal here is to get out of that bear market trash. Like, we don't want to deal with any of that crap. So here we just went from 9,000, what was it? 9,000 stocks and ETFs, 9,500. And now we have 1,369. So we're doing a pretty good job. We already whittled down the universe of stocks that we could potentially be looking at from over 9,000 to just a little over 1,000. First, we're going to take off ETFs, and that's going to whittle it down to 400. Amazing. Look at that. Magical. We just took 9,500 stocks down to 418. What do all 418 of these have? They've IPO'd within the last 2 years. That's a really good place to start. Next thing you want to do is add some sort of volume requirement. It doesn't have to be over 1 million. We generally use over 1 million as our benchmark because we want liquidity, right? We need people to be trading these things. But because of the recent IPOs, we're going to go over 500,000. We just whittled it down from over 400 to 111, which is not a bad place to go either. If you're trading options, well, you obviously need to have an options chain. So why not tick optionable and shortable? Now we have 40. You guys realize what I'm doing here? We just took 9,500 fucking stocks in the universe and whittled it down to 40 that are starting to fit the framework that we're looking to trade. IPOs in the last 2 years, average volume over 500,000. So you know that there's people actually trading it. No ETFs, has an options chain, and you can short it, which is very important from an option standpoint, because if you're trading options, you need to be able to have an options chain. The next thing that I like to do is I like to look for strength. And so you can utilize any of the 50-day, 20-day, 52 week. It doesn't matter. But we're going to start with 50-day highs, and we have one, Kava. So we're going to look at Kava. Well, let's go chart Kava really quick. There it is. There's not a bad little setup. As a matter of fact, as we pull up Kava, you're probably going to see that we have charted it before. I know we've looked at it a million times. There you go. There's the Kava trade. So I didn't personally take this. Some guys in TTI did. It was a winning trade. But there is very little difference between this setup and the ARM setup. I just showed you exactly how to build this scanner so you can find your own. Look for range breakouts on IPO stocks, like IPO stocks that within the last 2 years are breaking out, finding new highs. In this case, market corrected. Remember, last year from late July through late October, the market went down and so did Kava. Makes total sense. Then Kava went sideways. What's the next stage in Stan Weinstein's stage cycle? What's the next market phase in Richard Wyckoff's market model? It's a fucking uptrend. That's how this stuff works. All you need to do is figure out where you want to risk. Well, it makes sense that here, support gets broken, resistance multiple times, then all of a sudden it gets broken. I mean, it's not rocket science, guys. Come on. All you got to do when you want these things is buy the breakout and understand where your risk on, risk off levels are. You can throw a cute little Fibonacci extension on there if you want to be able to base your stops, take profits off of math. This is always going to be generally a 3-to-1 setup. If you're buying the one and selling the one 1.618 and stopping out on the 786. In this case, we drew some fibs across the entire thing because we think Kava is going to break out to all-time highs and we're going to want to own it above $58. But we took the liberty of buying the actual base stage 1 accumulation here, which, by the way, if you don't know what that is, different video, but there's a webinar on it. You can validate financial institutional accumulation by looking at your VRVP indicator. What does this do? It tells you volume by price instead of volume by time. Very, very important piece of the swing trading puzzle if you're looking to buy these stage 2 breakouts. So Kava is one of them. Not bad. We want to own it again above 58. Shout out to the guys inside of the trading initiative that are still holding this position in particular. But there's only one. So let's go back to this and I'll show you a little trick. If you think about it really quick, let's go back here. 50-day highs, if you're scanning for these, you're generally going to get breakouts. Right? It makes sense. Things are generally breaking out. They're already up and over some overhead resistance. They're in uptrends. It's a 50-day high. That's enough data for you to go. That's probably a pretty strong intermediate uptrend at the very minimum. But what happens if you want stocks that have not yet broken out? Right? Now, you can buy these. We buy these all the time, but we buy them on pullbacks. I mean, that's kind of our bread and butter inside of TTI. For example, I can give you Kava in general. That is a high volume breakout. Verify it with the RVol, or with the volume bar rather. That is up and over the squiggly moving average. That is a high volume breakout. What happens on high volume breakouts over resistance areas? 66% of the time you get a pullback. We got a pullback the very next day. People got in. So that's our breakout retest bounce setup. You'll learn if you join. But let's say you don't know that, or you don't feel comfortable buying breakout. You want to set these things up a few days before. Totally. I get it. We run that too. So what we can do, and I have not run this scan, so I have no idea what we're going to find. 0 to 5% below the high. Let's see what we got. We got a couple more. Thank fucking Christ. So what we're looking at here is the 50-day high is going to give us names that are already breaking out. We could potentially be buying the pullback. If we go 0 to 5% below the 50-day high, we're generally finding names that are pressing up into overhead resistance, or at least there's a good opportunity that these things are pressing up into overhead resistance. So you can time the buy at the breakout if you want. So we're going to look through these really quick. Does this look good? That looks like shit. GCT is a name that we're in. At least one of us is in. This is the #1 rated stock in IBD right now based off of relative strength and technical setup. This was a big blue sky setup. Played it twice. First entry, second entry, and an ad here. Kind of looks a little crazy. I don't want to go through this one in particular. Tom, I know you're going to watch this. Shout out to you. Tom's the big winner here in GCT, but this is, once again, a big blue sky breakout. You have the recent IPO, stage 1 into a stage 2. Came back down, retested previous resistance, now turned support. You could load it again if you wanted. They did. Loaded the dip on the way up, and there you go. So there's another example. In this particular one, I don't know if I'd go out and buy that right now, but it's on the list, so I wanted to go ahead and give it a shout out. Here's the GE spinoff, healthcare of General Electric. We've talked about owning this many times, but we never pulled the trigger. You can see that we had the general idea, the big blue sky breakout, but we never actually pulled the trigger on this. Would have been an okay trade. I think it would have been pretty difficult, to be honest. In hindsight, that looks like a nice uptrend, but holding options contracts through chop like that and these big wicks can be emotionally draining. So if you're not ready for that, this chart probably is going to be a difficult buy. But I will say that if we get up and over this volume node, which once again, look at your VRVP to figure out where the volume is. Price has traded above this level, right? Right here. So most people would probably wait for an all-time high breakout, which makes sense. It's like, I get it. Wait for the all-time high breakout. But what happens if I told you to verify that there's even volume up there? Because why would you inherently wait for the all-time high breakout? Because there's typically going to be buyers up here that are going to want to offload their shares at break even. They bought the all-time high. They just held from April of 2023, and they're like, I just want out at break even. I'm never going to buy a shitty stock like this again. Totally understand behavior is like that, right? We understand that. But if we can verify that there's very little volume up here at the all-time high, think about how much resistance is actually going to be up there. Not that much, because nobody really bought up there. Yes, people bought, but how much? Not that much. As a matter of fact, the majority of the volume is right here. Majority of the people have been buying between $63.5 and $83. So where can we actually buy GEHC with relative ease that this thing is going to continue to fly in the direction that it is? I'd say probably $83. I would just consider this an outlier and not even give a shit about it. So this is a big blue sky breakout. It's a recent IPO into an all-time high. It's the same thing as ARM. The difference is this base has had 1 to 1.5 years to base, as ARM had like a couple of weeks. So GEHC, I have no idea what the options chain look like. As of right now, once again, we didn't buy it for a reason back then. I don't remember why, but there's a potential setup that we found using this specific scanner. And just so you know, we use a slightly different scanner, but I wanted to show you how we build one so you can go and do this stuff yourself. Let's look at VLTO really quick. No idea what this looks like. This isn't, I mean, this is okay too. It's a little bit lower of an ADR. Once again, we generally want higher ADRs on these. This is a large cap though, so I guess it's okay that it's moving a little bit slower. But once again, just draw your horizontal level. Where's the volume? Somewhere right here. Buy the fucking breakout. Just buy the breakout. See what happens. The worst thing that could happen is you lose a couple bucks if it doesn't continue. But the reward here is that you're in big blue sky territory. The market has no idea how to price these things. And next thing you know, they're up 20 to 40% in like a week or two. It happens all the time. Happened in ARM, happened in Kava. It's happened in GCT. Like I have a million different examples off the top of my head. Sentinel-1 we traded as an IPO high. Way back here, this was an IPO high breakout. Like we traded that. What's another one off the top of my head? CTLT? No. CFLT? Confluent, is this one of them? Yeah, this was another one of the stage 1 into stage 2 breakouts off of a recent IPO. So this is not just a random type of setup. You can absolutely utilize this in your specific trading. Once again, I'm going to go back and give you a look at the scanner, tweak the settings to make them make sense to you. If you don't like 50-day highs, you can always go to 20-day highs to get a quicker jump on things. But remember, the shorter the time frame, the less probable things are actually going to play out. That's the spin-off, right? You're going to get a better entry on a 20-day high, but it's going to be less probable that the trend continues. And obviously, if you go to something like a 52-week high, it's a higher chance that this is going to be high. It's a higher chance that this is going to work.